Good morning and welcome to Trading Hour. It is the last day of what has been a rather eventful week. Our team at TH is here to take you through the next 1 hour, and the screen is looking quite interesting, perhaps to say the least. Let's pull up the Nifty intraday and see what's going on. I just want to start with the Nifty intraday, and then we'll take it to my co-hosts, and that's the chart. The market always gets a little worried every time you get into this gentle downward slope. And that process is kind of underway, not quite, still about 0.5% higher. But let's see. That's the catchphrase, Pavitra, isn't it? Because a lot of the Asian markets are still doing better. Well, we're up, for what it's worth, 0.5% right now.
Like you said, it's just been a crazy week. And we've seen so much go down already. In fact, let's take a look at some of the sectoral moves that have come through this week. And you can see the kinds of cuts that we've seen. The PSU Bank Index has definitely been the weakest. It's down 5.5%. You have the Nifty Private Bank, which has seen a 3.5% cut. Nifty Auto down 3.3%. That entire chart should come up for you. IT metals both seeing a cut of around 2%. So across the board, there has been selling pressure, whichever sector you look at. Today, the big focus is really on tech, right? Because most of the tech stocks are in the green, but TCS on the back of the announcement that came through last evening is the one which is in the red right now. So that is up on your screen. By the way, a lot of mid-cap IT companies also surging. We'll have Nimesh to fill us in with some details on an interesting report which has come through on this space. And the other space which is really surging today is the real estate pack. So, take a look at any of those stocks after the clarification that came through from DLF on the fact that they have in fact sold, all of those plots in Gurugram. That entire pack of stocks really surging.
Oh, yes, they are. Again, don't want to be the party spoiler here, but just keep your eye out on the Bank Nifty as well. And that has always been this market's Achilles heel in the last so many sessions. Even now, the Bank Nifty is now precariously close to the flat line, just about 30 points higher. And that's the reason why the Nifty is also cooling off. So let's see how this goes. We're still, pretty early in the trading session, but the headline and the spotlight really is on TCS. The stock has had a very interesting journey right from the start, from 915, opened down about 0.5%. Now it's trying to recover some ground. It's actually, not even properly flat, traded in positive. Just about 0.2% of a decline. So this is a good time to bring in Rima, who will talk about a lot of other things. But Rima, we have to start with TCS. You take it away on the big story and the developments from last evening.
Thank you very much for that. In a sudden and shocking leadership change in India's largest IT services company, TCS, Rajesh Gopinathan has tendered his resignation after a successful 6-year stint as the managing director and CEO of the company. Mr. K. Krithivasan has been appointed as the Chief Executive Officer designate with effect from 16th of March 2023. Now, the street has been taken aback completely by surprise by this development, as just last year, in March of 2022, Rajesh was reappointed as the MD and CEO for a period of 5 years, which ends only in February of 2027, which means he stepped down 4 years before his term comes to an end. TCS has stuck to its policy of promoting an internal talent with Krithivasan, a veteran at TCS, to the top position. Now, he has experience across multiple functions, and he has been leading the company's largest vertical, BFSI, which contributes over a third of TCS's revenues by heading it for more than a decade. And Rajesh will ensure that it's a smooth transition by staying on until September 15, 2023, which means 6 months. Now, what will be the ask from the new CEO? Now, today at the presser conducted by TCS, we asked Krithivasan all this, and he said TCS has been built on 2 pillars: customer centricity and employees, and he wants to double down on making customer relationships stronger. When asked whether there will be any big strategic shifts, changes under him, Krithi replied that priorities and strategies do not change with CEO changes. So I guess we should expect more of the same. So what are brokerages made of this development? So let me start with Bernstein. They're saying the leadership change was unexpected during a challenging macro environment. CLSA says, given the age of TCS's senior leadership, Krithivasan is 58 years old, while NGS or N. Ganapathy Subramaniam, the COO of the company, is 63 years old. So CLSA believes that succession planning could become a point of focus, especially for long-term investors. Morgan Stanley says it may create a short-term overhang. However, they expect the transition to be smooth and well-managed as seen in the stock, and they don't think the stock is likely to underperform in the coming months. Back to you.
All right, Reema, thanks a lot for getting us all of the details there on the big change of guard at TCS. But in fact, this morning, we also had the management address the press. So let's listen into a few of those comments.
We have brought the volatility of the pandemic to a fair state. We have registered very strong growth, first bouncing off the pandemic lows with 15%. And then over the last 9 months also, we have still grown at 14.8%. And crossed big milestones. What next is first have to make sure that the transition happens smoothly. And with Kriti being there, I don't think that is a challenge at all. If you look at the volatility or the demand outlook, I don't think we are in a majorly concerning situation. Yeah, there is inflationary pressure. There is talk of recession. So maybe the recession will materialize. Maybe it will be more severe than what we thought it was. But that's all part and parcel of the business cycle and part of the business environment that we operate in.
TCS has been built on two important foundational pillars of customer centricity, as well as a huge set of employees who are always committed and who are given their best to TCS. I'm hoping to lead this company and double down on our core pillars of customer centricity, meeting more employees and meeting more customers and making the relationship stronger.
All right, that is the word coming in from the team at TCS. But staying with the IT space, Nimesh is also here with us, and he's standing by with the highlights of a report that Morgan Stanley published on the space. Nimesh, what do they have to say?
Hi, there is a big report from Morgan Stanley on IT names today. They've changed the preferences within the IT names, and they've double upgraded Cyient to overweight from underweight, and they've sharply raised the target price there. So in terms of changes, a big overweight on L&T Mindtree as well as on Cyient, and they've downgraded Infosys and Tech Mahindra to equal weight from overweight. Now coming to the overweights, as I said, a big double upgrade on Cyient from Morgan Stanley. There they've raised the target price to 1100 from 730 earlier, and on L&T Mindtree they've raised the target price down to 5600 versus 4600 earlier. Now the key reason for the upgrade, for the changes and the upgrades is they believe that there are more tailwinds, which will overweight the headwinds as far as the margins are concerned for most of the IT names, and within that their preferences include L&T Mindtree, TCS, and HCL Tech. They are the best position because they have the margin levers relative to the other peers. So on back of all this, 4 big changes, 2 upgrades, which is Cyient and L&T Mindtree, and they've downgraded to the Infosys and Tech Mahindra to equal weight from overweight.
Okay, thank you very much for that. Through the course of the day, we'll talk more about the upgrades made by Morgan Stanley on LTI Mindtree and Cyient. For now, we need to slip into a very short break. We'll come back and discuss commodities. Manisha Gupta joins in as always.
Welcome back. We've been talking a lot about equities. Let's also figure out what's happening in the world of commodities. Manisha Gupta is joining in for that. Manisha, we've discussed, I think, agricultural commodities and these monsoon issues a lot. I believe now you are looking at gold?
I am, yes. The need to talk about something positive has been so strong, and this is the only sector that really seems to be closing on a very positive note. So whether you look at gold or silver prices, this is the strongest week in 2 months that we seem to be registering right now. It's trading in the positive right now as well, and the gold prices have gained up by 3% in this week. Silver is up 6.5%, platinum up by 2% as well. The support really seems to be coming in from the fact that the US dollar index has declined yet again. That has been supportive, and then the safe haven buying because of the banking sector concerns has been supportive. We've seen that flight to safety come in for the precious metal prices. Also, markets are now putting in a probability of nearly 90% of a 25 basis point rate hike for the month of March, and that really is a big one when it comes to the bulls in precious metals there. The only reason, the copper, the reason that you talk about copper within precious metals is because that tells you on what really is happening in the other commodities. So this is one metal that has declined by 4% in this week. There are demand concerns. The Chinese data has not come in so well. The home sale numbers have declined for a 10th straight month. So all of that flight to safety while has happened in precious metals. Most of the metals have seen a decline. Copper clearly leading all of that.
All right, Manisha, thanks a lot for getting us all of the details on the move that we've seen in metal prices. With that, we do need to get into a short break. The market has moved to the low point of the day. The Nifty Bank right now also in the red. So it's seen a sharp correction over there led by names like Indices, SBI, Axis also at the low point of the day. So take that break. But when we come back, we're going to get you a technical check on this market with Mitesh Thakkar. Hey guys, welcome back. You're still tuned into Trading Hour on CNBC-TV18. For the market, we have moved to the low point of the day. From the top of the session, it's a 90-point cut that we have seen. So let's get Mitesh in to take us through a quick check on this market. Mitesh, once again, we got that gap up start. We've come off significantly from that level, led by what's going on with the banks, right? Do you expect to see much more of a fall in this session?
Yeah, in fact, good afternoon. I think my sense was that we have kind of bounced back from a support level, but we haven't given a reversal, and that would have happened had we managed to start trading above 17,150, 17,160 zones, and we got a high of around 17,145. So this is a market which may not fall much, though I think, when I say fall much, it's in comparison to the low which we made yesterday. So 16,800, I think, should be a good floor, give and take a few points, but hasn't got the strength or signals of reversals on the upside. So it will be choppy range-bound market within about 350-point kind of a band, which is from 16,800 to about 17,150. In that sense, we could retest the 16,800 level, so therefore falls, the declines could happen in the next couple of hours. But broadly, I expect 16,800 to hold out for the next few days, and then we might see some base building within this choppy range and try for a reversal. So for the timing, the market index, I think, I have a mild negative bias. A retest of 16,800 is what I'm looking at, but not a significant break below that. And trading is more stock specific.
And could you elaborate a bit more on the individual stocks which catch your attention today?
Yeah. I have one buy and one sell call. The FMCG names are on the buying side. We have seen good traction come in many of these names. So Tata Consumer is something which is giving a good reversal. Buy here with a stop at 696. Look for targets of 725. And ITC is something which is, after a long time, seen, is giving strong signals of profit booking. Has broken the 20-day average and the 10-day average, and now is turning negative. So that's a sell with a stop at about 378 for targets of 360.
Okay, got that, Mitesh. Thank you very much for giving us some of those calls right now. We'll touch base with you again later in the afternoon. With that, let's move on to two stocks that are seeing a fair amount of green on the screen. I'm talking about HCL, Hindustan Aeronautics, as well as Bharat Forge, both up between 2 to 3%. And this is on the back of the Defense Ministry approving a rather large tranche of orders. We're talking a total of 70,000 crores. Vivek is here. Vivek, it sounds like a huge number. So tell us a little more about the details and whether these companies really benefit.
Well, absolutely. Yeah. The headline number, of course, is very large, 70,000 crore, spread across, three main order wins. So when you're talking about the three segments, it's helicopters, it's ATAGs, that's the advanced artillery gun systems, and the BrahMos missile. So now, this 70,000 crore, it has to be divided into the number of years as well as the number of orders as well as the operation and maintenance contract. So first, let's have a look at, how HCL benefits from this particular development. Indian Navy is going to buy 60 utility helicopters, marine chopper, from the company. The total order size is 32,000 crore, which is divided into the actual delivery of the order as well as the services and spare supply that the company will enter into. Along with that, the Indian Coast Guard is also going to get advanced light helicopters from the company. Now, this particular order win is worth around 1,500 to 3,000 crore as per analysts. Now, coming to Bharat Forge in a JV with Tata Advanced Systems will be getting an order for the ATAG howitzer. Now, this particular order win is worth 8,000 crore. So these order wins will get awarded over the next couple of years. Yesterday, the proposal has been clear. The actual orders are yet to come in.
Okay, thank you very much for that. Let's talk a bit about Cyient, right? That's a stock that Nimesh earlier told us how Morgan Stanley has given it a double upgrade. So quickly to tell you the reasons why. For one, Cyient gets a lot of revenues from the aerospace industries. Nearly 18% of their consolidated revenues comes in from aerospace. If you add communications and railways, it's about 44% of their revenues. And this is a space which went through a cyclical downturn, but now given the volumes, the pickup in volumes that we've seen for in the aerospace sector, this vertical for Cyient is likely to do well. It's already started to do well. The company is focusing a lot on improving margins. So that's the second lever. And third, they're looking at value unlocking. Now, the company has already filed a DRHP with SEBI to separately list their products business called DLM. Once that happens, it will perhaps help shareholders make some more money. And finally, the fourth reason is the valuations of Cyient at 12.5 times FY25 PE. They're in line with their historical averages, but they're cheaper than what peers are reporting, and that is the comparison plate, right? Cyient is trading at attractive valuations according to Morgan Stanley. So those are 4 reasons why Morgan Stanley today has double upgraded Cyient. Here's what we'll do. We'll slip into a very short break. We'll come back and discuss the way forward with Jigar Mistry of Buoyant Capital. Welcome back. Let's talk about the markets and where we are headed. Jigar Mistry, co-founder of Buoyant Capital, now is with us on the show now. Jigar, this has been an extremely volatile week for our markets. We've been pummeled due to the concerns of the health of the banking system in US and Europe. The Indian banks too have been punished, and so many analysts have done a hard check on what the status check of the Indian banks are and whether they're really going to be affected. But still, the Nifty PSU banking index is down 5%. The banks themselves have been underperforming. What have you made of the interlinkages people are making, the connections that they're making with respect to the sell-off out here in India? And does that throw up an opportunity?
Yes, good morning, Rima. Thank you for inviting me to your show again. See, I think I would say 95% of the time market is broadly sort of rational, reacts to the right data points. But 5% of the time, when things are really up in the air, you don't really know how to do what, right? So if you look at what's really happened with either the SVB or potentially what's happening with Credit Suisse, and we are trying to extrapolate on how that impacts the Indian banking sector, there is very little sort of correlation, if at all there is one. SVB traditionally was, a case of a misguided duration on treasury. And they held a lot of assets in treasury, resulting in the losses that were booked. And then the hand was forced by the credit rating agencies, then a botched sort of an equity raising attempt. And that led to, the sort of deposit run that eventually transpired. Now, if you look at the situation in India, none of the banks, so your obviously SLR ratio is around 18%. Banks are holding in and around that number, slightly higher. PSUs are holding up 22, 23 odd % levels. And whatever is there in the HTM, even if you include the AFS, analysts have done the number crunching, and they suggest that, even if the yields were to move adversely, you're not likely to see sort of an impact of more than 5 to 7% of 1 year's PBT, right? For PSUs, for private banks, it's even lower. So I think, because a smaller regional bank was sold off, you come around and then you sell the smaller banks in India, looks a little far-fetched to me. I think what's really happening is that, a stronger US dollar essentially means that foreign investors look to sell all risky assets. Emerging market then is classified as a risky asset, which includes India, and therefore they are exiting, but sort of tampering the positions. And if you look at the sort of stocks that FIs own, we did an analysis some time ago. Of the 10 sort of largest over-ownership, 6 were banks. Now if you include HDFC Limited as well as a bank. So, if they are exiting, they only can sell what they own. And therefore, I think what's confused as a flow-driven impact is being mistaken for a fundamental impact. And I think whenever there is a sort of a disconnect between the two, it does offer a reasonably good opportunity. The bank numbers in India have been phenomenally good. I wrote a little while ago that all the 4 cycles look more or less aligned, like the credit growth cycle, your NIM cycle, your credit cost cycle, and valuation cycle. I think they are reasonably well in tune. So banking is one place that we are finding a lot of value in the sort of sell-off that's happening here.
Okay, finding a lot of value in the banking names, and this sell-off can perhaps provide, a good opportunity to get into some of these names. Jigar, what else do you like at these levels? Because a lot of these, blue chip stocks have corrected significantly from the top, bringing down the valuations. Is there something else that you would look at? And do you think the FMCG space in particular looks good now?
Good morning, Pavitra. No, sort of FMCG is not really out there, because I think if you look at the high frequency data in India, the sort of pain is just starting to get a little more visible. So I think, that's not a space, and valuations have corrected. You are absolutely right, but not to a level where, they start looking a lot more attractive. I think an emerging space could really sort of come through in the tech space now. For a major part of the last few sort of quarters, at least I'd say at least 5 odd quarters, we have been very circumspect on that space. But I think now people are getting a little bit confused regarding the role of a central bank. It's not just basically this financial stability, but it's also the inflation targeting. And if they have to play both the roles, it's a very tightrope walk for them. Right now, in trying to do that, what they might end up doing is they might not reduce the rates, but then keep the liquidity high, as you saw with what ECB did last evening. And even if you look at the US sort of liquidity that's flown through, they've not abandoned QT, but the liquidity has increased almost $200 billion overnight, because they have to sort of accommodate the deposits. Now, if that was to transpire, then you are looking at sort of, the valuation multiples for a lot of your tech names which have corrected. I think they are entering a reasonably good zone. I'm not saying that they would just bottom around here and turn around, but I think in the next quarter or so, they would come to very interesting levels, which may make a lot of sense.
Okay, by the way, we need to draw your attention to the market all over again, and this is not looking good at all. Nifty Bank has slipped into negative, and the Nifty is barely positive now. On a morning like this, when, of course, let's pull up the stocks and see what's going on. This is not a good looking screen at all, because you've got a lot of global support, a lot of global markets holding up. We were talking about Asia. Those markets are up between 1% and 2%. But India is a very different story, at least as of now. Let's look at where the pressure is coming in. Obviously, it's the banks which have been the big culprits of the last couple of days. And even today, IndusInd Bank, some of these names are on the downside. ITC seeing, by the way, a lot of selling, 3% down on ITC. We are seeing iSure and Hero Moto lower. Let's just pull up Nifty losers, actually. A lot of auto stocks on the losing side of the screen. TCS itself is down about 0.5%. And then you have some of the banks like SBI, Axis. All of them have moved to the lower side of the screen. Actually, the counterweight is coming in from the non-TCS IT names. You've got HCL Tech and Infosys that are holding up. Otherwise, this is a very slippery looking screen. Jigar, your thoughts on just, how one should approach the market here in India now, given the way the tape is playing. Almost on a daily basis, the market has become a sell-on rally or sell-on bounce. Would that bother you at all? Or if not, then which pockets would you look to start deploying money in?
All right, Sumaira. So, if you sort of look at India per se, then I think it's time to sort of go back to the first principles, which is, if you look at GDP, right, it's consumption, investments, government spending, and net exports. Now, given what's transpired, you are having net exports which would take a little bit of the sheen out. Given higher interest rates, some investments will be taken, a little bit of a beating. But besides that, all that sort of tantamounts to is slightly lower GDP than what we would have otherwise thought. Now, if you sort of look at what really drives this, you will arguably have a much lower lower crude prices. And even if a stronger dollar means that some amount of FPI flows out, the BOP is unchanged, right? Let's imagine crude goes down, your current account surplus happens, or current account deficit reduces. and let's say US dollar sort of appreciates and FI outflow happens, the amount of BOP does not really change, but the quality changes dramatically, right? Because crude driven is a revenue expenditure, FDI, FI is a capital inflow. And therefore, I would actually view this, albeit it will be painful for a month or 2 months, I don't think really this impacts India in a very bad light. Obviously, see, in the shorter term, day to day, your markets tend to be a lot more driven by, what the flows impact is. So I think some amount of murmurs will happen, but I don't really think what's transpiring is bad for India's economy per se.
Jigar, we'll have to leave the conversation here today. Thank you very much for joining in and have a lovely weekend. Just the point about IT, a lot of brokerages are holding their conferences globally in India as well as outside, and they've met with all the large cap IT companies. And the key takeaway from that is that while there is a lot of noise, there is a lot of uncertainty, at least on the margin front, companies appear to be protected. On account of the decline in attrition. So the key takeaway is that even if there is some fluctuation, maybe weakness on the top line, analysts tell me that at the EPS level, there is unlikely to be any change because margins are likely to improve from here on because of lower wage bills, because attrition is coming down, so there is a lower backfill cost. So at least EPS-wise, companies and IT stocks are protected. Get into a break. On the other side, we'll get you more on the markets. Welcome back. Let's shift our attention now to a corporate conversation. Now, yesterday, I caught up with Mr. Shailendra Kumar, who heads the Oracle business out here in India. He's the MD of Oracle India. And we had a long freewheeling chat about the prospects of cloud business, how the adoption has been, and what are Oracle's growth forecasts for the cloud business in India. Listen in to a slice of that conversation.
Important point, because what we are looking forward to is sustaining a similar kind of growth in triple digit. And we have that kind of bookings with us that really help us to achieve that number. The way we see in the market, most of our customers are optimizing. They are unifying their operations. They are making them much more efficient. And the best way to do is using cloud, either on the infrastructure side, on the platform side, on the SaaS side. You just spoke about our numbers tripling 125%. I will also tell you the number of consuming customers, they have grown up by 44%.
Last year or in the first half?
The first half.
Okay.
Our business in public sector has grown 5 times. Our SaaS business in BFSI has grown something like 74%. Our SaaS business in education and research has grown over 100%. And you know, the hottest market today is healthcare. In healthcare, our SaaS business has gone up something like 160%. So our customers are looking forward to make their overall operations much more efficient. They are looking forward to transform themselves so that they have better access to the market. They can take their products in no time and overall can see much better profitability compared to they see today. So to answer your question, of course, we look forward and we have plans to ensure that our business keeps growing triple digit even next year.
So this year, FY23, India cloud business for Oracle will see 100% plus growth, and even in FY24. You have the visibility right now.
That's right.
Okay, that's good to know. But yeah, go ahead.
In fact, the reason I'm so confident about this is because the plans we have made with our customers about FY24. But more important than that, most of the deals we have signed are multi-year deals. Multi-year deals, and they are multi-million, multi-year deals. That really has the plan. How do we see in the next 3 years, 5 years, and 7 years?
Got it. But the naysayers would say that it's easy for you to grow in triple digits because your base is much smaller than your competitors, right? You are a late entrant into the Indian market. When do you think you will be able to catch up with the Azures and AWSs of the world in terms of overall size? I know growth rate you're higher, but what about matching them in size?
So if someone had spoken to me, say around 3 years, 4 years back in India that your base is small, I would have agreed to it. But in the last 4 years, we have really covered a big ground. On the other side, if you see globally, I gave you the India numbers, globally we have grown 45%. And we are the fastest growing cloud provider in the market. So globally, you can make out the numbers are not small, they're very, very big, but even then 45%. And our CEO, Safra, also gave the guidance for Q4. They are equally compelling, the kind of numbers we're talking for our Q4 that ends on May 31st.
Since you brought up the subject of your global peers guidance seems to be suggesting some sort of a slowdown or the growth rate. What AWS or Azure have seen in the current quarter, they've seen a growth of about 31-32% thereabout, which compares with over 50% growth that they had 2 years back. So hyperscalers are seeing a slowdown in growth.
Coming to the same point, our customers, and we have big enterprises.
But how is it different, right?
We have big enterprises, and that's the kind of enterprises we are working with. And these enterprises are growing. What they want is better optimization, better efficiency, better systems in terms of security, performance, scalability. And that's the reason they're looking at us.
So your enterprises are growing, but your peers are catering to enterprises which is slowing down.
It also talks about the kind of services you have, the kind of innovation you are doing in the market. Just to give an example, we have revamped Oracle completely. In the last 10 years, it has completely transformed to a cloud organization. Today, the way we hire, the way we train, the way we do our internal processes, all our internal operations, finance, everything is running on the cloud. How many companies have you heard closing their quarter and releasing their results in a matter of 10 days? Only Oracle does it. So if you talk about innovation, you talk about growth, you talk about how do we take our products to the market, I think we have differentiated. At the same time, our customers are loving it.
Okay. Talking about the India business, you are planning to pivot a bit. Like 3 years back, 100% of your revenues came in from large enterprises. Now, as we speak, 70% comes from enterprises and 30% comes from SMB, which also includes startups. In the next few years, how do you expect this mix to change for India and why?
So first of all, my 70% from enterprise today is still much healthier compared to what I got 100% from enterprises 3 years back. And 3 years back, we started a new division called Oracle Digital, especially to focus on SMBs and startups, which has grown like anything, much faster than the triple-digit numbers we spoke about. So it has gone quite well. As we go forward, I think this 70% will be 50%, but still a much higher number. And our digital business, Oracle Digital business for SMBs and startup will also be there. So in the next 3 years, I would say 50-50.
Very bullish commentary coming in from Oracle India. This is a testimony to the cloud services that Indian companies are taking on board. So this is across sectors. The Oracle largely caters to the BFSI, telecom and the government sector, but they're very confident about 100% plus growth in FY23 and FY24. That is the visibility that they have given the deals that they've signed on. And now increasingly, they're also seeing demand coming in from the SMB sector, the small, medium businesses. So historically, or say 3 years back, 100% of their cloud revenues would come in from the large companies, the enterprises. Now, as we speak, that shift has moved towards 70% from the enterprises to 30% from SMBs, the smaller companies. But going forward in the next 3 years, what the management is telling us is that more SMBs will sign on and get on to cloud because they expect the revenue mix to change to 50-50. 50% from enterprises, the large companies, and 50% from the small and medium enterprises, which basically means that cloud in a way is going to be ubiquitous. It's not going to be the domain of only the large companies. Even the smaller companies are all joining the cloud bandwagon. Get into a break. We'll come back with more on the markets.
Hey guys, welcome back to Trading Hour. Let's get you an exclusive conversation now. The new urban extension road 2 connecting North Delhi with the Delhi-Jaipur highway will be open to the public later this year, and the key road is expected to help ease traffic congestion on the national capital and cut the commute time to the airport to just 20 minutes from the 2 hours that it takes currently. So my colleague Danish Anand spoke to Nitin Gadkari, who's Road Transport and Highways Minister, about this mega project. Let's listen into that conversation.
This is the lifeline actually, because majority the traffic jam and pollution in Delhi because of from traffic to north to south is coming to Delhi. It's from Kashmir, Uttarakhand, Himachal, Punjab, Haryana. The traffic going to the south, all traffic coming into the center part of the Delhi. That is why Dhawla Kuwa, the ring road is totally jammed and the air pollution is there. Now, presently it takes from that point, starting point of this road, to airport 2 hours. But by this road it will be only 20 minutes. So it is going to reduce the traffic, jam as well as time and fuel and pollution. This is to be a great thing for Delhi, that it will give the great relief to the people of Delhi as far as this pollution is concerned.
Right. So you also said that for Delhi especially, the ministry has earmarked 60,000 crores for development of all the road and other connections. So what is next in the future for Delhi to easing congestion in Delhi? What next can we expect?
First of all, we have completed 2 projects. Delhi Meerut, that is of 12,000 crore, and that is of 8,000 crore, and Delhi Peripheral Road is of 12,000 crore. So the 20,000 crore projects we have already completed. There are also 5 more big projects, major projects, and there are also medium-sized projects of 2,000, 3 to 4 projects. And at the end of this December, 70 to 80% of the work will be completed, and after that we will think about new projects. Now the basic responsibility, whatever the responsibility is taken now, we have to complete that first.
So very lastly, what are your plans regarding electric highways? When can we expect the first pilot to begin?
From starting point of this highway, the idea is to make e-highway up to Jaipur, where electric bus, electric double-decker bus, electric truck. The last lane will be dedicated for electric cable, and now the technology is developed by which we can take trolley bus, double-decker bus, e-bus and e-truck. That can save the fuel at the same time. 100 rupees of diesel is equal to 10 rupees of electricity. So by giving more comforts, AC bus and everything, we will reduce the ticket rate by 30%.
Okay, with plans for roads and electric mobility there. Mr. Nitin Gadkari detailing out some of those nuances. We'll take a break on that note. Actually, we will be wrapping up the show itself. Do stay with us because all the action will continue. Up next is Halftime Report.